Financial Reporting Through the Lens of a Property Casualty Actuary. Part 6, Differences from Statutory to Other Financial or Regulatory Reporting Frameworks in the U.S. Chapter 24, International Financial Reporting Standards. International Financial Reporting Standards, IFRS, is a single set of global financial reporting standards issued by the International Accounting Standards Board, IASB. It was developed in the public interest as a high-quality set of general-purpose standards that will provide users across borders and industries with transparent and comparable information. That is, they provide the world's integrated capital markets with a common language for financial reporting. Most of the world's major economies permit or require the use of IFRS. The European Union, Canada, Hong Kong, and Australia are among the economies that use IFRS. At the time of writing, the Securities and Exchange Commission, SEC, in the U.S. does not allow domestic issuers of financial statements the ability to file using IFRS rather than U.S. Generally Accepted Accounting Principles, or GAAP. But it currently permits foreign issuers to do so without reconciliation to U.S. GAAP. In 2005, the IASB realized it was unable to issue a new standard for insurance contracts before IFRS was due to be implemented in the European Union. Consequently, under time constraints, the IASB issued an interim standard known as IFRS 4. IFRS 4 allowed entities to use a wide variety of accounting practices for insurance contracts, reflecting national accounting requirements and variations within the respective requirements. For instance, companies were allowed to continue their local GAAP, but with minimum rules around that practice. However, the standard did not adequately reflect the true underlying financial position or performance of the insurance contracts, as the contracts are accounted for differently across jurisdictions as national accounting requirements were allowed to be adopted. The contracts often cover difficult-to-measure long-term and complex risks with uncertain outcomes. Contracts are not typically traded in the market, and they may include a significant investment or deposit component, the amount that the insurer is liable to pay the policyholder regardless of whether the insured event occurs. To address the issues above, in May 2017, the IASB issued IFRS 17, which was initially set to be effective on or after January 1, 2021, superseding IFRS 4. However, in 2018, the IASB voted to defer its effective date to January 1, 2022. IFRS establishes principles for the recognition, measurement, presentation, and disclosure of insurance contracts. The objective is to A. Improve comparability between insureds, harmonization of insurance practices across jurisdictions, and new accounting framework to replace the varying accounting treatments. B. Improve quality of financial information, inclusion of useful information in the financial statements, and increase transparency on insurers' profitability. Scope. IFRS 17 applies to contracts that are insurance contracts issued, reinsurance contracts held, and investment contracts with discretionary participation features. Similar to IFRS 4, it does not apply to insurance contracts in which the company is the policyholder, with the exception that the contracts are reinsurance contracts. The new standard retains the IFRS 4 definition of an insurance and reinsurance contract, which is, quote, a contract under which one party, the insurer, accepts significant insurance risk from another party, the policyholder, by agreeing to compensate the policyholder if a specified uncertain future event, the insured event, adversely affects the policyholder, end quote. Level of aggregation. IFRS 17 provides a consistent framework for accounting for all insurance contracts issued. A company applies the requirements of IFRS 17 to a group of insurance contracts rather than on a contract-by-contract basis. In grouping insurance contracts, a company is required to identify portfolios of contracts and divide each portfolio into A. A group of contracts that are onerous at initial recognition, B. A group of contracts at initial recognition that have no significant possibility of becoming onerous subsequently, and C. A group of remaining contracts. contracts issued more than 1 year apart can't be grouped into the same group. Measurement model. The standard introduced a new measurement model referred to as the general model, with the measurement objective of fulfillment value for insurance contracts. Two variants of the general model were also defined by the standard: the premium allocation approach, or PAA, and the variable fee approach, VFA. General model. The general model is the default model in IFRS 17. Under this model, insurance contracts are to be reported on the balance sheet as the total of A. Fulfillment cash flows, the current estimate of amounts that the insurer expects to collect from premiums and pay out for claims, benefits, and expenses, including an adjustment for the timing and risk of those cash flows, and B. Contractual service margin, CSM, the expected profit for providing future insurance coverage, i.e. the unearned profit. The fulfillment cash flows consist of the present value of future cash flows and a provision for risk adjustment. The risk adjustment component represents compensation that an insurer requires for bearing the uncertainty about the amount and timing of the cash flows that arise as it fulfills the insurance contract. Upon initial recognition, the CSM is defined as the net difference between the fulfillment cash inflows and outflows, floored by zero. The CSM cannot be negative. If it is negative upon inception, the expected losses are to be recognized in the income statement immediately. The purpose of recognizing a positive initial CSM is to report expected profitability arising from the contract over time, reflecting the service to be provided. The standard requires companies to update the fulfillment cash flows at each reporting date, using current estimates that are consistent with relevant market information. For instance, companies are to use current discount rates to measure insurance contracts. Using current discount rates as opposed to historical rates, i.e. discount rates during contract inception, or a mix of rates, will reflect the characteristics of the cash flows arising from the insurance contract liabilities in a consistent manner across all companies. As such, changes in insurance obligations due to economic factors, i.e. interest rates, will be reflected in the financial statements in a timely way. Premium allocation approach. The PAA is a simplification of the general model. It is an option that insurers can elect to implement if the model is expected to produce results that would not differ materially from the general model, and if it doesn't contain any complex features. There is a safe harbor for contracts that have a coverage period of 12 months or less. Other contracts can be tested to allow them to use the PAA over the general model. The PAA splits the measurement of groups of insurance contracts into two pieces where needed: the liability for remaining coverage and the liability for incurred claims. The liability for remaining coverage is approximately equal to the unearned premium, less any premium receivable and deferred acquisition costs. The liability for incurred claims is measured using the fulfillment cash flows from the general model. No CSM is required for this portion of the liability, as the coverage from the contract has expired for this portion of the liability. Variable fee approach. The VFA is based on the general model, but with additional features to account for contracts with direct participating features. Overall, IFRS 17 and its basis for conclusions published by the IASB total 240 pages. It covers in-depth topics such as what is considered an insurance contract, and therefore needs to be accounted for under the standard, the boundaries of such contracts, more specifics around the building blocks, fulfillment cash flows and CSM, the option to lock in discount rates to avoid income statement volatility from mismatched accounting of assets, recognition of revenue, and required disclosures. At the time of writing of this text, significant amounts of accounting and actuarial literature have been published on how to implement this complex standard. No doubt much more will be written in the coming years as the implementation date is reached. Those interested in reading more should first look to International Actuarial Note 100 that will be published by the International Actuarial Association during 2020.